Okay, the AM trend. Now, obviously, when we refer to the AM trend, we're going to always have in the forefront of our minds the traditional overnight session, what was seen as the London session. And the New York AM session is defined by 9:30 a.m. to noon New York time. The true day high or low will tend to form in between the hours of 9:30 a.m. and 10:30 a.m. New York time. Between the open at 9:30 a.m. and noon New York time, there is typically a trend or price swing daily. This is referred to as the AM trend or morning swing. The AM trend can be a continuation of overnight direction or an outright reversal of direction right from the opening at 9:30 a.m. You want to study many days of intraday price action to learn how consistent this morning price swing is. The AM trend can end at 10:30 a.m. to 11 a.m., but anticipate it continuing up to noon or the New York lunch hour. Okay, you can classically see the London session price action overnight. This is the London session. And then at 9:30 a.m., the equities market open. That's when we start looking for our indices for index trades. And again, bar chart's always going to be showing it as central time, so that's going to be 1 hour behind in the data. So it looks like 8:30 here to 11 a.m. is actually 9:30 a.m. to noon New York time. So this is our New York AM session. And the AM trend begins at 9:30 a.m. or 8:30 Central, as shown on the barchart.com charts. And the AM trend ends at noon or 11 a.m. Central as it relates to barchart.com's data. As you can see here, during the New York session, price trades up into a bearish order block, and that gives you the price swing for the AM trend seen here. Okay, as another example, I want to just give you a few examples to study so that way you can go through as many sample size of data that you can consume as a study, but I want you to go back as far as you can using barchart.com, and you can look at all of the indices. You can look at the NASDAQ, the Dow, the S&P. You can actually look at the DAX and FTSE as well if you want to be looking at other indices. Looking at the London session here overnight again. And then we have the New York AM session. And right at the beginning of the AM session, we have price trading down into a previous down close candle or bullish order block. And then price expands on the upside off of the run into the bullish order block. Notice the highs forming at 10:30 a.m. New York time. Another example here, the London overnight session. And we have the New York AM session. And price drops down into the range that was created during the London session. And it fills in a fair value gap. Only wicks were being shown here. We like to see bodies. The bodies has to cross. That's efficiently traded. So we see 2 wicks there. The candle comes down and wicks into it during the New York AM session. Rebels, reprices higher, and runs out off of a bullish order block later on in the New York AM session, creating the AM trend from 23.9450 up to 23.9950. And again, it's a bullish order block seen. Another example here, we have the London session, and we have the New York AM session. Again, we have price trading down at the beginning of the New York AM session at 9:30 a.m. New York time. Price trades down into a previous down close candle, bullish order block. Seen here, and price trades from the 23.52 handle all the way up into almost the 23.68, but trades to 23.67 big figure. Another example here, we have the London session. Now we're going to be looking at the Dow E-mini futures. So as a contrast, we see the London session, the New York AM session, and notice that we have here price trading from London. We traded all the way down and cleared a level of stops right here, and that's our bullish breaker. So at the beginning of the New York AM session, we can anticipate that expansion based on institutional order flow and the fact that during London we had a breaker. Those last two up close candles during the London session, that's the catalyst for them selling. So they're going to be looking to reduce or remove that exposure by going long there. And it happens at the beginning of the New York AM session, or 9:30 a.m. equities open. So that expansive move, that is actually a precursor by looking at the London session run out on the lows. Now we're going to contrast the NASDAQ E-mini. Again, we're looking at the London session. And then we have the New York AM session. Okay, and we see the New York equities open at 9:30, or shown as 8:30 here in Central Time on barchart.com. We have price running out a previous low as a turtle soup. And now we're going to look at the index SMT. Between 5 a.m. and 9:30 a.m. New York time, relative highs and lows should be compared. When institutional order flow is bullish, what that means, we have to be comparing relative lows across the three indices. One index will fail to confirm a lower low. It's usually typically seen, or what we expected to see, in all three. So as all three are trading lower while it's bullish, one index is going to fail to make a lower low. When that occurs, that's your bullish confirmation for trading the AM trend. That's seen here, where at the top chart is the NASDAQ E-mini futures, 15-minute time frame. And from 5 a.m. into 9:30 equities open, or in Central Time, it's 4 a.m. to 8:30 a.m. It makes a lower low right at the beginning of the New York AM session. But the Dow, which is the middle chart, from 4 a.m. Central Time to 8:30 Central Time, or 5 a.m. New York time to 9:30 a.m. equities open, it creates a higher low. Then at 4 a.m. Central Time to 8:30 a.m. Central Time, or what would be 5 a.m. to 9:30 equities open in New York time, the S&P mini futures makes a higher low. So by looking at those three indices, you can see there's a massive accumulation under the Dow futures and on the S&P 500. While the tech sector rallied off of that divergence, by far and large, all of the indices moved up as the accumulation pattern takes place in price action. So the index SMT gives us a confirmation that there is something bullish going on behind the scenes. And we used some of the precursors in institutional order flow and reference points in the previous slides to frame what those catalysts were in respective terms to the NASDAQ, the Dow, and the S&P E-mini futures. Now, when institutional order flow is bearish, we would be comparing comparable highs between 5 a.m. New York time to 9:30 a.m. equities open. One indice is going to fail to confirm a higher high that would be normally expected while they all move up in general tandem. One will fail to do that when it's bearish institutional order flow. And by comparing highs that's seen between 5 a.m. and New York's 9:30 a.m. equities open, you're looking at 4.5 hours of time. Now, it isn't going to be always like you're seeing here, where at exactly the 5 a.m. hour, it creates a specific low, and then it creates a lower low or a failure to make a lower low at 9:30 a.m. There may be a low seen at, for instance, 7 o'clock in the morning, New York time, and then 9:30 in the morning, New York time. Those lows, they may diverge. Okay, so when I say that you're looking at relative highs and relative lows across the spectrum of time, okay, of 5 a.m. in New York time to equities 9:30 a.m., that's your span, or basically like a kill zone. Think of it like that. So between that 5 a.m. and 9:30 a.m. time, it's 4.5 hours of time where you're constantly scouting when the price action is bullish on the higher time frame daily. If we're expecting this trade higher based on institutional order flow, and we drop down to say a 4 and a 1 hour basis, we're looking for PD arrays, just like we've done in all the other asset classes thus far. When we look for these evidences to support the bullishness or bearishness in price, the filter is when institutional order flow is bullish, comparably, the lows, okay, when price is bullish overall, we're going to be looking for price to fail to make a lower low while it's retracing. We'll see that footprint of smart money by way of the index SMT, because greed and the sheer size of their orders and buying will always create this pattern. It'll be there. Significant trading opportunities will always have this hallmark to it. And when institutional order flow is bearish, we're going to be looking for comparable highs between 5 a.m. and 9:30 a.m. And it may be a matter of simply the opening at 9:30 a.m. equities, then 8:30 a.m. it may be a comparable high or comparable low. So don't think that it's exactly at 5 a.m. and 9:30 a.m. Okay, don't think like they're goalposts and that defines it as bookends. And they don't specifically create those highs and lows. It can, as being shown here, but between the 5 a.m. New York time and 9:30 equities open New York time, you're going to be looking for relative lows and relative highs and just compare them. That's why it's important that you look at a large sample size, because you're going to see how it will show you that crack in correlation where otherwise the indices should be moving in tandem. As they drop lower, all three should be moving in concert with one another. But when it's bullish, one will fail to do that, and we're simply just applying Dow theory is all it is. But timing in the relative terms to whether institutional order flow is bullish or bearish, and then bracketing out a specific time window, which is, again, 5 a.m. to 9:30 a.m. Now, 5 a.m., why are we looking at the beginning of 5 a.m.? Because London traders are going to be taking their lunch then, and they're going to come back at some time. What time? Who knows? It could be 5:30. It could be 6 o'clock in the morning New York time. So we start waiting for that buildup of orders that come by way of the UK and European traders that want to trade the indices in the North American continent, NASDAQ, Dow, and E-mini futures. So they're going to be still trading. They still have time of the day left for their trading day, and they're going to be looking for opportunities to pour money into it. So large flows will pull in, and that crack in correlation when the market's really not going to go lower, you can anticipate, for instance, if you were trading the NASDAQ as your cup of tea indice, you could look at this particular day here and see the massive buildup at the lows on the Dow and the S&P 500. So you know with a great deal of confidence that run under the 5 a.m. low on NASDAQ, that's a stop run. And quickly we reprice the NASDAQ futures higher after that low has been violated from the 5 a.m. The other trading indices, we have to factor in institutional order flow and reference points and expansion type ideas. So when it's bullish, as indicated in this example here, if price is expected to go higher, we see the divergence or failure to go lower on the Dow and S&P 500 those ideas, you start looking for expansion moves. So what I do is I look for opportunities to trade on buying on a stop. So you can be a buyer on a stop or wait for price to trade up through an old high. And if that happens, we can also anticipate the breakout above down close candles, which would otherwise at a later time become bullish order blocks. So we can be ahead of the curve by buying on a stop on a down close candle, whatever that high is. Our buy stop could be placed above that, and that would be our entry tool or entry technique. Otherwise, the indice that trades below an old low and bucks that overall trend, two of them are diverging or going higher while one goes down. Your eye should go right to that one that's making a lower low and identify that as turtle soup. That's a run on stops. Buy it below the old low. So you're using two types of framework here to be a trader for trading indices. You can be buying on a stop, buying strength, or buying weakness under an old low and scooping up that sell side liquidity, pairing up your entry there. Either one is fine. There's not one over the other in terms of advantage. They're all three going to move in tandem once the setup takes place, as being explained here. Now, typically there will be an index SMT divergence to qualify the AM trend setups a few times a week. There's been some instances over my observations when I was really active in following the indices where there's been every single trading day, there's been some measure of an index SMT divergence. It does not equate to a large opportunity with low risk, but if you look hard enough and scout it hard enough, you'll find a crack in the correlation, and then there's some kind of a little move that takes place. It's important to look for them, but don't strain your eye looking for them. What do I mean by that? When it's not obvious, assume it's not there. If it isn't clear, as you're seeing here, this is so clear and so telling that it's classic. This is what you're looking for. And when it happens in price action live, when we watch price action, looking at the equities open at 9:30, as traders and developing traders, when we're looking for these concepts to build our confidence, to eventually use them at your own choosing, okay, to help you build confidence behind your analysis. When we see this happen over and over and over again, it builds an understanding, it builds anticipatory price skills, and also it removes that fear of the question that comes up all the time: how do I know to be buying a turtle soup under an old low? That's scary. Well, when you see these patterns like this, when you have two indices saying they want to go lower and one does, the one that does go lower, that's a turtle soup. You can buy it right below that old low, feel confident that you're doing so, and watch it rip. And generally, as you see here, the speed will be seen at the one that makes the lower low because they want to quickly get out of there after the stops are taken. The one that has the expansion move, they can be a little bit more lethargic, but they're both, the ones that diverge still will go up. But the one that hits the stops, speed will generally be seen there. It doesn't always equate to magnitude, though, so just have that in mind. So we're going to build on this concept of the AM trend when we do the setups teaching as number 5 in the index trading concepts. The next lesson I'm going to be teaching you is the PM trend, and we'll talk about time and price as it relates to indices, and we'll also talk about the effects of the New York lunch hour. And until next lesson, I wish you good luck and good trading.